If you've spent any time in investing spaces online, you've seen the debate. VOO or VTI? Should I add SCHD? Is SCHD actually good or is it overhyped? Everyone has an opinion, and half of them contradict each other. Here's what nobody tells you. All three of these ETFs are excellent, but picking the wrong one for your situation could mean thousands of dollars less in retirement or years of waiting for income that never comes when you need it. I'm going to break down all three today, what they actually hold, how they've actually performed, and which one makes sense depending on where you are in your investing journey. No fluff. Let's get into it. Why this comparison matters. Before we dive in, I want to explain why I think this comparison is actually worth your time. Because on the surface, these funds look pretty similar. They're all US focused, they're all passively managed, they all have rock-bottom expense ratios. But underneath the hood, they have very different philosophies. VOO and VTI are both growth-oriented total return funds. SCHD is built around dividend quality and income generation, and that philosophical difference creates real, meaningful divergence in how they behave, especially during market downturns, tech rallies, and rising interest rate environments. So this isn't just a performance horse race. It's about understanding what you're actually buying and whether it matches what you're trying to build. Fund number 1, VOO. Let's start with VOO, Vanguard's S&P 500 ETF. VOO tracks the S&P 500 index, which means you're buying a slice of the 500 largest publicly traded U.S. companies, weighted by market cap. The bigger the company, the more of your money goes into it. Right now, that means a heavy concentration in mega-cap tech. Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet. The top 10 holdings alone make up over 30% of the fund. VOO launched in 2010 and has delivered roughly 13–14% annualized returns over the past decade, though a more conservative long-run expectation is closer to 10% annually, which is still exceptional. The expense ratio is just 0.03%. That means on a $10,000 investment, you're paying $3 a year in fees, almost nothing. The case for VOO, it's the simplest, most proven way to capture broad U.S. market growth. Warren Buffett has famously said that most investors would be better off just buying an S&P 500 index fund. VOO is exactly that. You get instant diversification across 500 companies across every major sector. The case against VOO, that concentration in the top 10 is a double-edged sword. When big tech runs, VOO runs. But when big tech corrects, like it did in 2022, VOO drops hard too. You're not as diversified as you might think when one sector drives so much of your returns. Who is VOO for? Long-term growth investors, especially anyone under 50 who doesn't need income from their portfolio yet. It's a set-it-and-forget-it core holding.
Fund number 2, VTI. Next up is VTI, Vanguard's Total Stock Market ETF. VTI doesn't just track the S&P 500, it tracks the entire U.S. stock market, over 3,500 companies, from large caps all the way down to small and micro-cap stocks. That's a big difference in theory. In practice, the difference is actually pretty small. Here's why. Because VTI is also market cap weighted, the largest companies still dominate. The top holdings in VTI look almost identical to VOO: Apple, Microsoft, NVIDIA, Amazon. The S&P 500 makes up roughly 85% of VTI's total weight. The extra 15% you get is exposure to mid, small, and micro-cap U.S. companies. So does that extra 15% matter? It depends on your time horizon and your views on small-cap stocks. Historically, small-cap stocks have outperformed large caps over very long periods. This is sometimes called the small-cap premium. But it comes with more volatility, and there have been decades where small caps significantly underperformed. Over the last 10 to 15 years, large-cap tech dominated, and the small-cap premium has been largely absent. Going forward, some analysts believe small caps are undervalued relative to large caps and could outperform. That would give VTI an edge over VOO. Others think the mega-cap dominance continues and the difference remains negligible. The expense ratio is the same, 0.03%. The case for VTI, broadest possible U.S. diversification. If you believe in American business as a whole, not just the 500 biggest names, VTI captures all of it. It's also the purest expression of passive indexing philosophy. The case against VTI, the added diversification is mostly theoretical. The day-to-day and year-to-year performance is almost indistinguishable from VOO. If you already hold VOO, there's no meaningful reason to switch. Who is VTI for? Same profile as VOO, long-term growth investors. Choose VTI if you want the most complete U.S. market exposure. Choose VOO if you want simplicity and slightly less small-cap exposure.
Now here's where it gets interesting. SCHD, the Schwab US Dividend Equity ETF.
SCHD is a completely different animal. It doesn't try to track the whole market or the biggest companies. It specifically screens for high-quality U.S. companies with strong dividend histories, companies that have paid and grown their dividends consistently for at least 10 years, with strong cash flow, low debt, and solid return on equity. The result is a portfolio that looks totally different from VO or VTI. You get much more exposure to sectors like financials, healthcare, consumer staples, and energy, and much less exposure to tech. Amazon and Nvidia are basically non-existent in SCHD. Right now, SCHD yields around 3 to 4%, and it has raised its dividend every single year since its 2011 inception. That dividend growth is the key feature. A yield of 3.5% that grows 10 to 12% per year is incredibly powerful over a long time horizon. In 10 to 15 years, the income generated on your original investment can be massive. The case for SCHD: income and stability. During 2022's brutal bear market, SCHD held up significantly better than VO and VTI because dividend payers with strong fundamentals tend to be defensive. If you're building toward retirement income or already in retirement, SCHD gives you cash flow without forcing you to sell shares. And the companies in SCHD tend to be financially rock solid. The case against SCHD: in strong bull markets driven by tech and growth, SCHD will lag. From 2019 to 2021, it significantly underperformed VOO. If your goal is pure wealth accumulation over 20-30 years, you're likely leaving total return on the table by going SCHD only. Who is SCHD for? Income-focused investors, people approaching or in retirement, or anyone who wants to add a defensive income layer to a growth-heavy portfolio? Head-to-head, performance and real numbers. All right, let's put some real numbers on this. Over the past 10 years, VO has averaged roughly 13% annually. VTI has been nearly identical, maybe 0.2 to 0.3% behind in some periods due to small cap drag. SCHD has averaged around 11 to 12% annually on a total return basis. That includes dividends reinvested, which is actually very competitive. But here's the nuance. SCHD's total return is heavily driven by dividend reinvestment. Its price appreciation alone is lower, so if you're spending the dividends rather than reinvesting, your total return looks quite different from VOO. In a down market, 2022 being the clearest recent example, SCHD dropped about 5 to 6%, while VOO dropped around 18%. That's a massive difference if you're in retirement and can't afford to wait for a recovery. The takeaway: VOO and VTI win on long-term total return in bull markets. SCHD wins on income, stability, and downside protection.
How to combine them. Here's what the most thoughtful investors actually do. They don't pick just one. They combine them. The most popular combo I see is a 70-30 split. 70% VOO or VTI for growth and 30% SCHD for income and stability. This gives you strong long-term growth potential while building a dividend income stream that can eventually fund part of your retirement lifestyle. A more aggressive approach for younger investors might be 90% VOO and 10% SCHD, just a small dividend anchor while you're still in pure accumulation mode. And for someone closer to or in retirement, flipping that ratio makes a lot of sense. 40% VOO or VTI, 60% SCHD. More income, less volatility. The point is, these funds aren't competitors, they're complementary. Choosing the right ratio for your stage of life is the real skill. My honest take: if I had to give you a direct answer, here it is. If you're young, early in your career, and building wealth with a 20-30-year horizon, VOO or VTI. Pick one. It almost doesn't matter which. Don't overthink it. Just invest consistently and let compounding do the work. If you're 10 to 15 years from retirement and starting to think about income, start building your SCHD position. Let those dividends compound now so you have a real income stream when you need it. If you're already in retirement, SCHD becomes much more central. The income, the stability, and the quality of companies in that fund are exactly what you want. And honestly, for most people, a simple two-fund combo of VOO plus SCHD held forever is a genuinely excellent long-term portfolio. So here's my question for you. Which of these are you holding right now? And what's your split? Drop it in the comments. I read all of them, and I genuinely love seeing how people are building their portfolios at different stages of life. If this video helped clarify the differences for you, hit the like button. It takes 2 seconds, and it helps this channel reach more people who are trying to get smarter about their money. And if you want to go deeper, I've got videos on building a dividend portfolio from scratch and how to actually structure your retirement income strategy, both linked in the description below. Subscribe if you haven't already, and I'll see you in the next one.